pleasure to be at this first installment of a new symposium series, which I'm sure is going to turn into a scintillating annual tradition. The defining feature of the modern financial market is its tight interlinkages. Episodes such as the Great Financial Crisis serve as reminders that shocks originating in one corner of the world can quickly spread. An important class of shocks are demand shocks. They arise frequently. And although they're not necessarily motivated by new fundamental information, they can nonetheless move prices powerfully. Of course, in an interlinked world, demand shocks rarely affect one single asset. Consider a currency intervention by a central bank. The target currency's exchange rate might move, but so might many other currencies. Which ones, and by how much? Answers to these questions can really help us design effective policies. And so in this paper, we ask, how do demand shocks propagate across financial assets? We argue that demand shocks propagate through traded risk factors because intermediaries are averse to absorbing these non-diversifiable risks. Here's what we have in mind. When a demand shock hits asset A, that also changes some demand of some underlying non-diversifiable risk, which can be represented by a risk factor. To clear the market, marginal agents, oftentimes intermediaries, they require that the price on this non-diversifiable risk to change. That change then affects all the other financial assets that are exposed to this non-diversifiable risk, including asset B. You might be wondering why we're taking this detour through risk factors when ultimately we just want to go from asset A to asset B. And that's really because all financial assets are so tightly linked. And so to characterize demand propagation across a market of n asset, you would need to know n squared cross-impact parameters. But genuine asset-specific demand variations are almost impossible to identify. Progress then hinges on imposing some structure. The structure that we choose is rooted in non-diversifiable risks because these risks have been known as the main drivers for the cross movements in asset prices. To operationalize this framework, we overcome two important challenges. First, which non-diversifiable risks are traded and therefore susceptible to demand shocks? Historically, people have identified the risk factors by looking at returns and returns alone. That's all well and good, but the resulting factors may not be traded. Conversely, people have looked at just trading quantities, yet the resulting portfolios may not actually capture any underlying risk. And so we devised a new methodology that jointly analyzes return and trading data to recover the most traded risk factors. But secondly, even with just K factors, if a demand shock to one of these factors can affect the price of all the other factors, you've still got K squared difficult to pin down parameters. Our solution is to construct these traded risk factors to have both uncorrelated returns and uncorrelated flows. Effectively, these traded risk factors represent independent sources of risks that are also traded independently by agents, thus eliminating any cross-impact. And so we are left with just K parameters for the K factors, one mapping to each of the factors, directly capturing intermediaries or the marginal agent's risk aversion to absorbing these risks. Moreover, this orthogonalization enables an instrumental variable strategy that's made more credible so that we can actually estimate these parameters. We apply our framework to the foreign exchange market where demand shocks abound. Moreover, by for example, the triangular arbitrage holding, we know that this market exemplifies tight connections. Thankfully, this market is also suited for a framework that's rooted in non-diversifiable risks. Marginal agents who absorb trading imbalance on this market, who tends to be financial intermediaries, they have deep and liquid trading among themselves, such that returns in the space already reflect strong considerations for non-diversifiable risks. Moreover, a novel new data that's now made available by the CLS group gives us the net trading facing financial intermediaries. So it now becomes feasible to actually study the risks that intermediaries bear in trading. We find that in FX, just 3 traded risk factors can account for 90% of the non-diversifiable risks in trading. And because intermediaries are averse to absorbing these non-diversifiable risks, in fact, using the instrumental variable strategy, we find that their risk-taking capacity in FX can be even more limited compared to that of US equity. Because of these two things, demand shocks can propagate. We characterize how demand shocks can propagate across 17 currencies and 5 non-FX asset classes, where the propagation can be strong among certain assets, but more muted among others, highlighting an integrated yet complex financial market. And so in the paper, we have a very careful theory section. In the interest of time today, I'll just walk through the main intuition of what it is that motivates our empirical exercise. So we have a 2-period foreign currency model and a mass mu of competitive intermediaries with power preference and a risk aversion of gamma. Now imagine there's a demand shock. That should move the price from PN to a new price. Let's denote the percentage price change as the delta small pn. Now, as we said, because oftentimes demand shocks, they don't just happen to one isolated asset, but the demand shocks can happen to many assets concurrently. In fact, how much that price for currency N changes is going to be a function of the demand shocks that are hitting all of the assets in the market. By standard equilibrium optimization, we derive an expression that looks quite complicated. However, we can always come up with some sort of factors that we can construct to be orthogonal. And if we construct these factors to be orthogonal, then we can restate that price change as simply this lambda, which is the price sensitivity, multiplied by the risk of the factor and the demand for this factor, where that demand for that factor is the sum of the beta of each of the assets vis-a-vis this factor and the individual shocks to these assets. And so now we can give lambda a very intuitive explanation. It's not just proportional to the risk aversion, which is the source of friction in this model, but it's also kind of the per unit of trading-induced risk price response. Just one problem, though. According to this very standard static equilibrium model, we have just one lambda, and so we have, in fact, the same price sensitivity for all factors. But this stands in contrast with some of the evidence that we know in terms of unconditional risk-return trade-off and the more empirical evidence that we're finding for different portfolios. And so what we're going to do is we're going to relax this restriction and allow lambda to be potentially factor-specific. Viewed through the lens of the model, you can think that it's intermediaries or marginal agents having different risk aversion, or more plausibly, you can think that there are different massive agents, mass mu, of intermediaries that are trading these different assets, leading to effectively different risk aversions. With K lambda, then, we have K distinct price sensitivity. And so the way that currency M's demand is going to affect currency N's price is going to follow the following 3 steps. First, that demand change to currency M is going to entail some change in the underlying factor K. By how much? As we've shown before, that just corresponds to the beta. Next, now that the factor demand for K has changed, the price of K must also change to incentivize the marginal agents to clear the market. By how much? By this lambda that we hopefully will estimate. Finally, once the factor price has changed, now all of the other assets, including asset N or currency N, must also change to hold the law of one price. The only remaining question that we have to tackle is which set of risk factors should we be looking at? As I've alluded to, although theoretically we just need uncorrelated return to guarantee no cross-factor impact, in reality, because agents tend to trade correlated portfolios, that they could also, in fact, trade many of these independent sources of risk correlatedly, to truly guarantee that there is no cross-factor demand spillover, we would like to construct the most traded risk factors that have both uncorrelated returns and uncorrelated flows. To put simply, whereas the traditional PCA on return only requires orthogonal returns, and the PCA on flow would only require orthogonality among trading, what we're going to do is try to find factors that will jointly have uncorrelated returns as well as uncorrelated flows. Great. That's everything that I want to cover in terms of how our empirical exercise is motivated. Now let's move into the exercise. The data comes from CLS, where we look at all the trades that happen between banks who map into the intermediaries in our model and all the customers that banks are trading with. Importantly, because we want to measure all of the FX risks that intermediaries might confront, we're going to look at not just trading in FX spot, but also FX trading in forwards and swaps. We're going to discount any FX exposure back to the spot. As you can imagine, that FX exposure is minuscule from FX swaps, but quite substantial from FX forwards. Finally, we'll have standard return data from Bloomberg, and we'll aggregate everything to the weekly level for analysis. And so here are our top 3 traded FX factors. First thing to note, on the very bottom, across the 3 factors, 90% of the variations can be jointly explained. Moreover, because our factors index so much on also how agents are trading, you'll see that the weights, these are portfolio weights, are consistently higher for currencies from developed economies. And we highlight these in red. Finally, if you really examine the size and the distribution of these portfolio weights, some patterns emerge. In fact, the first one looks like a dollar factor, where everything is negative. So the dollar, the weight on the US dollar, which is the negative of the sum of all the other currencies, is exactly 1. And factor 2 looks almost like a carry factor. And factor 3 has a pretty barbelled weight around euro and the yen. And so we're going to propose some canonical risk factors constructed exactly how you would imagine. And we're going to try to then orthogonalize these factors using the procedure that I've described so that they also have both uncorrelated returns and uncorrelated trading flows. And we see that we basically get back exactly the risk factors that we got out from the PCA exercise. In other words, we think that the factors are representing the risks traced out by the dollar, the carry, and what we call the residual euro-yen risk factor. Now that we have these factors, we can now, in fact, tell you how the trading flow into these factors have evolved over time. In particular, from the customer's perspective, they've really been demanding dollar throughout our sample period of a little over a decade. And in the meantime, they've held a pretty neutral position vis-a-vis the carry until quite recently, where they've massively sold off carry. But now moving on to the perhaps more exciting part, how do we think about estimating this factor price sensitivity, lambda? Remember that we've got k lambdas, or 3 lambdas that we want to estimate. what we need here are shocks to these factors so that we can trace out the corresponding price movement. The way that we would generate a shock is through an instrumental variable. That ideal instrument would induce trading, so relevant, carries no information, so exogenous, but also affect a factor's price only through the demand of that one factor. This last condition is in general very difficult to achieve because all assets are interlinked. It's just that in our specific framework, because we've constructed these factors to be mutually orthogonal, that indeed we're by construction guaranteeing that the return responds only to the demand of that particular factor. And so the instruments that we're going to propose are the week ahead announcements of the offering amount at upcoming sovereign bond auctions. They're relevant because foreigners often exchange for local currency to participate in auctions. And they're plausibly exogenous because the offering amount is actually heavily forward guided. In the US, for example, up to 2 quarters ahead, the TBAC will release a complete schedule of which security will be auctioned off when. And so when the actual auction announcement comes about a week ahead of the actual auction, there's not a lot of new information that market participants don't already know. Indeed, in fact, the effect of our instrumented demand shocks revert within just a month, telling you that it's not a permanent shift or drift in the price of these currencies. And so I think I only have 3 minutes, so let me truly speed through and tell you what the key punchline is. That the price sensitivity, in fact, increases for each of the factors, going from the better known dollar factor to the lesser known euro-yen residual factor that we're proposing, indicating that the risk-bearing capacity of the intermediaries is decreasing as we go down kind of this pecking order. Moreover, we can multiply this price sensitivity by the volatility or the risk of this factor to tell you what is the per $1 billion of demand shock impact. And compared to the comparable price impact in the equity market, what we find in the FX market is a lot higher, indicating a lot less capacity to absorb risk. Now that might stand in contrast to what Ingomar presented earlier today, showing the vast amount of trading in FX. But we have to remember that up to 75% of those trading are in fact between intermediaries to offset their trades. And so the actual amount of arbitrage capital able to absorb risk is rather limited. And so now that I have both the risk factors and the price sensitivity, I can then do a simple linear regression to understand the exposure of individual currencies to these risk factors and get this propagation or cross multiplier matrix. We can see that all of the loadings are positive because all of the currencies load on the dollar factor with the positive sign. Yet we observe low cross multiplier between the long and the short of the carry leg, because those currencies together will actually hedge out some of these risks that intermediaries are averse to absorbing. Finally, the euro and the yen, although they're both low interest rate currency, they're less substitutes to each other as complements because of this euro-yen residual factor. Finally, as a sensitivity check, the Hong Kong dollar has basically zero movement as it is pegged to the dollar. Lastly, we can extend this framework and in fact look at propagation not just across currencies, but across asset classes. Swapping in asset M and asset N wherever you saw currency M and currency N, we can now do the same exercise and try to find how shocks will propagate across asset classes as channeled by the 3 traded FX factors. And we find some really interesting patterns that we did not impose to the data. For example, the US Treasury is the sole asset class that can even have negative cross multipliers with the other asset class, highlighting its safe haven status. But really through the lens of our framework, it arises because the US Treasury is the sole asset class that has a negative loading to the carry factor. And so let me conclude. We started off with the question, how do demand shocks propagate through financial assets? And our answer is that demand shocks propagate through traded risk factors because of intermediaries' aversion to non-diversifiable risks. Overall, our findings truly highlight an integrated market and, more importantly, a portfolio rather than asset-by-asset view when thinking about demand shocks in an integrated and complex financial market. Thank you very much.
So first of all, thank you very much for this great opportunity for me to discuss this super interesting paper. So I've seen this paper a couple of times, including a full seminar at Hong Kong U. But every time I look at this paper, I learn something very new. All right. So I think the big picture of this paper is how does a shock in asset I affect asset J's price, and what is the underlying mechanism? So put it in regression form. Basically, we have a vector of the change of asset price on the left-hand side, and the vector of the change of quantities on the right-hand side. And here we assume that we have available exogenous shocks to the quantity demand. Okay, so let's say we forget about endogeneity, we forget about instruments. So the target of interest is this lambda matrix. So suppose we have n assets in the universe, then this lambda matrix will have n square elements, which is an impossible object to estimate. Okay, so to do this exercise, the essence of success is how can we reduce the dimension of this lambda matrix. So there are several existing approaches in the literature. For example, in the recent very popular approach of demand-based asset pricing pioneered by Koji and Yogo, what they do is they make a series of assumptions, and those assumptions lead to a logit demand system. Okay, so with the logit demand system, basically one can estimate a relative price elasticity, and then using that relative demand elasticity combined with the portfolio weights, we can effectively reduce this lambda matrix dimension into a very low dimension matrix. And maybe many of you have been are aware that recently there has been criticisms on this approach, and several new approaches have been proposed. For example, the Haddad et al. Paper. So they propose actually a different way of reducing the dimensionality of this lambda matrix. So they make this assumption that the substitution across assets are the same, conditional on the same characteristics. Okay, so that's a different way of reducing the dimension of the lambda matrix. Okay, so this paper actually effectively introduces a new way of reducing the dimensionality of the lambda. That is, they assume that the propagation is through factor trading. Well, essentially, factor trading means the investors, they absorb the demand shock from the customers through trading on a factor with predetermined weights. That is a natural implication for the standard asset pricing theory. Standard asset pricing theories tell us that marginal investors, they should trade the traded factor. Okay, so this is very natural and plausible to me. So specifically, the authors do it in 3 steps. First of all, they need to find out the factors that the investors trade most, combining the information on both prices and quantity. So that's one novelty of their approach. Not only look at the price or quantity, but combine them together. Second, they estimate the demand elasticity at the factor level because the marginal pricer is trading the factor. So the structural parameter is the factor level demand elasticity. And 3, they unpack the factor price change by assigning individual asset price change. That is implemented through very simple regressions. Okay, so how do they implement this approach? Well, the biggest challenge is how to find the factors, right? So they use a statistical procedure that requires the factors to have orthogonal returns and orthogonal factor flows, and then they rank these factors by the multiplication of the factor return and the flow variance. So this is what they do by combining the information on both price and the quantities, and then they use some plausible exogenous instruments on the government debt announcement or auction announcement to estimate the factor level elasticity. And then the last step is pretty straightforward. Okay, so what they find 3 factors: the dollar factor, the carry factor, and the residual factor that seems to be related to the euro-yen trading. And they find that upon the same magnitude of the customer demand shock, the FX prices seems to be moving more than the equities. Okay, so that reflects the limited arbitrage capital. So what lesson do we learn from this new approach? Well, the main lesson we learn is asset I's demand shock propagation into asset J's price depends on 3 things. First of all, how much does asset I contribute to the factor? Because the marginal pricer need to trade the factor. 2, what's the price elasticity at the factor level? And the 3, how much does J's contribution to the factor? Okay, so this is the main lesson of their approach. So overall, I think this is a very novel approach that uses the asset pricing theory's joint implication on the prices and quantities in uncovering the factors. And I view it as a very promising micro-foundation of factor trading. And especially, I think FX market is a very plausible application. If the application is in the equity market, I would have more concerns because it's hard to say like equity market has a single type of marginal pricers, right? We have retail investors, institutional investors, and they trade pretty differently. So if we aggregate them, who are they? We have no idea. But the FX market is a highly intermediated market. So it's much more plausible to assume that the intermediaries or the dealers, they are the marginal pricers in the FX market. And it's more plausible for us to estimate their demand elasticity at the factor level by assuming that they trade the factors. The paper, the execution is careful and thorough, so I think it's a very innovative and thought-provoking paper. It's an important contribution to both the FX and demand literature. So let's get to my comment. My comment number 1 is on the stability of the traded factors, or if I give it a big name, that is Lucas' critique. Okay, so this paper is to argue that the factor level parameters are structural. These parameters include both the factor weights and the factor price elasticities. But my question is, to what extent the factor weights are invariant to the shocks? For example, if there is a shock in currency X, regardless of what it is, does the dealer still stick to these ad hoc factor weights without adjustment? Because remember, the factor weights uncovered through a statistical procedure. Okay, it's not through an economic, a micro-funded economic model. So there is this possibility that once you have a shock, especially if the shock is big, then this factor composition would change. Okay, or more fundamentally, the question is what makes the traded factor? So, but I don't want you to take it as like a criticism of their approach, because this is a common challenge for all the demand-based approach, basically asking what is really the fundamental deep parameters. Are demand elasticities the fundamental deep parameters? So there are debates about that. So I think this is a pretty common critique or a common problem, challenge faced by this demand-based approach. But I want to be more specific on one thing, that is how we think about the role of the market size in this approach. Okay, so the corollary of their approach is basically a small currency will have relatively small price impact, almost by construction, because a small currency might have large loadings on their prices. But in terms of quantities, there is no way their loadings will be large because the market size is small, okay? So by looking at their results, we see that the 3 factors load mostly on US dollar, euro, Canadian dollar, Japanese yen. So these are all the currencies with the largest turnover. So it seems like those relatively small currencies, they're outside these 3 constructed factors. These currencies include like Australian dollar, New Zealand dollar. So these are like important currencies in carry trade, right? But in your factors, they have very little weights. So where do I see the tension? Well, for these relatively small currencies, and usually the liquidity of these currencies will be limited. So if there is a demand shock of a small currency X, usually we would think that, well, these markets are not very liquid, so the price impact would be large. But based on your factor approach, the price impact would be rather small. Why? Because these currencies contribute very little to the factor. So as a result, because these traders trade on the factors, so they don't really move the price a lot. So there seems to be a tension, right? So ultimately, my understanding, the source of the tension is because once these small currencies have large shocks, and then the factor might move, or the factor weights might not be invariant to these shocks. So that's one maybe big comment on this approach. Okay, so how stable are these factor weights? And the second comment is very simple. So I think this approach is very nice. But there's one way you can directly validate this approach. You can run this regression directly. You have plausible instruments, right? You can compare your direct estimate or the reduced form estimates with your more structural estimate. So if they align well, then that would be a validation of your approach. And my third comment is probably beyond the scope of the paper, to think about the fundamental risk and the trading-induced risk, because the factors you construct seem to be related to the dollar and the carry, but if you look at the specific weights, actually there is significant difference. For example, Australian dollar and New Zealand dollar have very little factor weights in your factors, so it seems like they're more fundamental rather than trading induced. So I think the factor weights you uncover can be informative about how much risk is fundamental and how much is trading induced. But I understand that this is well beyond the scope of your paper. So to conclude, I think this paper has a novel approach to study the demand shock propagation through factor trading. This is theoretically grounded in asset pricing theory, and the FX market application is very plausible. I have made 3 comments, and I recommend this paper to everyone. I think this is a really nice contribution. Thank you very much.
I'll keep it brief because I truly want to hear from the audience, but I want to first off thank Xiang for such a thoughtful discussion. And the only one thing that I want to clarify is something that I think is rather important. The key lesson, what determines this propagation? It is actually not I's and J's contribution to the factor. Rather, it is I's and J's exposure to the factor. You might be thinking that I'm splitting hair, but it's an important distinction because it's the distinction between beta and factor weights, okay? Because the factors are constructed from trading, and we really emphasize trading, as you would imagine, small currencies would have a very small weight in the factor. But that does not mean that the small currencies are not exposed to the constructed risk factors. And in particular, it does not preclude these small currencies from having a strong beta to these risk factors. And if they do, shocks to them will induce large price impacting other factors and vice versa. So this is a key distinction that I just want to clarify. And sort of related to this, where Xiang brought this up is this desire to understand where these factors come from, and I very much empathize, and I think this has been kind of the ongoing agenda for international finance community for the past decade and a half. It's hard when we just have a time series, just have one time series, right? In a related work, not on FX risk, but on the global synthetic funding market, which I hope you all keep your eyes out when we finally put out the working paper. There we have more heterogeneity in terms of who is doing what. So our observation can span more on the agent dimension. And once we have that, we can dig a little deeper as to what is driving what. But again, thank you very much for the discussion. I will respond to other points if they come across through the questions. Thank you.
Thank you. I wonder whether in your data set you can also show how the different agents, different types of traders, how their quantity traded relate to these factors. In other words, can we see really that the banks and, I don't know, other intermediaries are on the opposite side of hedge funds and so on?
Yeah, that's a great question. So our data,
so the CLS, as some people have already alluded to, and we'll hear more about it tomorrow from Ronaldo's presentation, they're very keen on preserving anonymity. And so for this particular exercise, what we observe is kind of banks vis-a-vis customers. We've got three types of customers, broadly speaking: corporations, non-bank financials, and funds, so like mutual funds, sovereign wealth funds, pension funds, so on and so forth. So we can draw a similar figure of who is trading what over time for those broad buckets of agents, but not so granular, certainly not necessarily from the intermediaries perspective, that can help us better tease out what is driving why certain risk factors are priced. But it's a point well taken. Yeah. And I think Andrea had a question.
Very nice presentation. I had a question on, like, in my view, I think a lot of the trading in FX market is more structural. Like, customers have a strong demand for having dollars, for example, and there's not that much trading on taking an exposure to a long-short portfolio. So what you just said previously, that even if there's a shock, say, in the Swedish krona, there can be statistically a big effect on some other currencies. I would assume that there's pretty strong segmentation across the different currencies, just because I really want dollar and I don't care, even if there's substitutability in a statistical sense. So I just wondered what your opinions are on, like, how segmentation impacts your results.
Again, an excellent question. So this has been kind of a prior that I've had about the FX market, which has been more validated based on this new data that we're working with on the global synthetic funding market. But the view that I maintain about the FX market is that it's actually a great analogy to the Venus-Villa preferred habitat model, where investors or customers, they have a very strong demand for individual currencies or a few set of currencies. At the same time, though, we see very strong co-movements in FX prices, including in a funding sense, like CIP deviations across different currencies, right? So that to me really points out or point to a role played by financial intermediaries or the marginal agents who are arbitraging across investors' segmented demand. So even though the individual demand might be very segmented, there are arbitrageurs who are playing the game across these segmented markets that are leading to strong co-movements at the market level. And in fact, that paper that I keep on alluding to is going to try to uncover what are the distinct markets in which arbitrageurs playing. Thank you.
That's an excellent paper, and it actually reflects the reality, the way we do things in practice.
Thank you.
The one thing I would say about the two betas, I mean, if you go back to the equations with the two betas, so the one thing that we would do is we will calculate the risk on the factor. So when I look at my exposure, I look at the beta of each of the markets, like, you know, Aussie dollar or NOK or whatever, into my carry factor or my dollar factor. But when it comes to hedging, when it comes to my second beta, I would use a different portfolio. Mm-hmm. So when we hedge things, we don't hedge things in like, oh, I'm going to take the entire factor and I'm going to hedge it out. Mm-hmm. I'm going to take my, you know, the most liquid part of my currencies, and I'm going to use it to hedge. And that, I think, actually speaks to the discussant point about the asymmetry between small and large currencies. We would prefer not to trade hedge the risk, the dollar risk, in using a small illiquid currency. We will much prefer to hedge that in the liquid currency. So you might be a way of doing it if basically we keep the betas for the correlation to see what the overall risk in the dollar, but then the other beta is the beta of what we trade. Like there will be a different set of betas, which are, if I've got NOK, then I'm going to trade it with SEK and Euro, which is slightly different to the betas which are used to calculate the risk.
Great, thank you very much for that perspective. I would love to take this conversation, especially offline, given the time constraint. I just want to say one thing, that in our framework, we don't quite see the second leg as kind of the hedging leg. Indeed, when we do talk about hedging in this other paper, there we do very much agree that most hedging actually is done through dollar because of the low price impact. But yes, thank you very much.